Assalamu alaikum and hi everyone. Welcome back. This is the third lecture on the MFRS 108 accounting policies, changes in accounting estimates and error. In our third lecture, we are going to now move on to the third part, which is on errors. MFRS 108 defines prior period errors as omission from and misstatement in the entity's financial statement for one or more periods. So there is a mistake or omission or misstatement in the financial statement for one or more period which arise from a failure of the company to use, or they use but they misuse reliable information that was available when the financial statement for those periods were authorized for issue. The information was available and could reasonably be expected to have been obtained and taken into account in the preparation and presentation of those financial statements. So the definition is relating to the prior period errors. Prior period error. In a simple word, prior period errors are those errors, material errors, that have been made in the prior or previous year, either several years, 1 year, a few years, retrospectively, financial statement, and are discovered during the current year or current period. So it had happened a few years back, but you only discovered in the current year. So certain errors are so significant that they render the financial statement to be fundamentally wrong. So it will not show true and fair view picture, and the financial statement is showing the information which are not reliable to the users, and they are not faithfully represented. You may also have current period error, where current period error is an error that has been made in the current year, and that error was discovered in the current year. Let's say the error was made at the beginning or somewhere the second month of the year. It was later discovered at the end of the reporting date. So that is an error that happened in the current period, and normally that error will be resolved by the reporting date before the financial statement is authorized for issue. So financial statements that do not comply with MFRS, if they do not comply with MFRS, whatever guidance or whatever rules and guideline, if they contain material errors, so they are said not to comply with the accounting standards, if they contain material errors or immaterial errors which are made intentionally, so the errors are being made on purpose to falsify certain items, to falsify certain amount, for example. So this is what you will regard as misapplication of accounting policies, where we talk about non-compliance with MFRS, and these errors can arise in respect of the recognition. So there are some recognition rules that you do not abide. Measurement, there are measurement that basis that you may not have accounted for correctly. Presentation, a wrong presentation, improper presentation, and disclosure. It will also involve, when we talk about error, we will normally talk about mistakes. So it is about mistake, but it's mistakes in accounting, they are called errors. Or sometimes that was due to oversight, that is how facts are being misrepresented, as well as when there is fraud. fraud, where we're talking about fraudulent transactions that are committed by maybe the directors of the company, the accountants of the company, or maybe the employee of the company. So when we talk about material, when is an item material? So an item is material if the omission or its misstatement of that particular item could individually or collectively influence the decision making or economic decision that were made by the users, which relies on the financial statement. So the decision was made on the basis of the information furnished in the financial statement, but there are some information which are not there, and that is material if that would affect the economic decision of that users. Materiality depends normally on the size and nature of the omission or misstatement. And misstatement judged in surrounding circumstances. The size or nature of an item or a combination of both could also be the determining factors. The size of the error, the nature of the item, or the combination of size and also nature could also determine the whether or not the item is material or not material. So some examples of errors include mistakes in casting of inventories. These were laid down by the paragraph under Mfrs 108. Go and check the Mfrs itself, check your textbook, chapter 5 on the Mfrs 108. Check that pages that were in those books and also in the Mfrs. Simply just a careless mathematical mistake, just casting error, for example. Mistakes in applying accounting policies. Let's say you incorrectly apply revaluation model to the item IP, where there is no such thing as a revaluation model to the IP. Misinterpretation of facts or oversight. You misinterpret the facts or you have overlooked those facts, and that misinterpretation caused the error. Fraudulent transaction, where there are transactions that were not really taking place, but somehow the evidence are being fake, and that create fraudulent transaction. Or maybe the transaction took place, but you have taken advantage of that particular transaction by taking some of them to your personal use. Those are fraudulent transaction. Misuse of accounting standards, where you misuse the accounting standards. Let's say the Mfrs 138 on intangible asset is being misused to justify the capitalization of development costs in the case of research and development. Now we move on to the recognition and measurement of error. Entity will normally correct the material prior period error retrospectively in the first set of the financial statement authorized for issue after their discovery. What is retrospective restatement? So when you talk about retrospective restatement, it is involving the correction to the recognition. You have wrongly recognized, you have to go and do the correction to the recognition. The correction to the measurement, you have wrongly measured the amount or wrongly used the measurement basis, and you need to do the restatement by correcting it retrospectively. Presentation, where you incorrectly present them in the financial statement, and disclosure, wrong disclosure, improper disclosure. Of what? Of amounts of elements of the financial statement, namely assets, liabilities, equity, income, and expenses. So if assets are being corrected, that was because there is an error. you go, maybe the asset was being understated or overstated, so does liabilities, equity, income, and expenses. Or sometimes that was also due to the wrong record made to the asset of, therefore that amount of elements of financial statement must be corrected as if a prior period error had never occurred. So it has to be done retrospectively. So the general principle in Mfrs 108 is that material errors in the prior period that have been committed in prior periods, if you discover it, must be corrected retrospectively. So if this is the current year and the error took place for several years, you need to do the correction for that several years. Year 1, year 2, year 3, and let's say year 4 is your current year. In the prior year, all the correction must be made. So when that is the error that happened in the current year. For error that happened in the prior period, sorry. So this one was referring to the error that took place in the prior period. So that has to be corrected retrospectively. All right. Now we look at prior period error. So it has to be corrected retrospectively, adjust retrospectively, retrospective restatement, and the current period error has to be adjusted prospectively. So you just start adjusting the error if that was the error discovered in the current period to those items that were wrongly recorded, for example, in the same period. That current period error should be adjusted prospectively as compared to retrospectively for the prior period error. What is retrospective restatement? Retrospective restatement means an entity do the correction of the material error of the prior period retrospectively in the first set of financial statement after the discovery of the errors. How? By restating the comparative amounts for the period presented which the error occurred. So you need to go and restate, let's say, the retained profit if the error has affected the retained profit. And that was maybe the comparative amount this year versus the one in the prior period. If the error occurred before the earliest prior period presented, maybe you need to go and also restate the opening balances of assets, liabilities, equity component for the earliest prior period presented. So you must go and adjust the opening balance of those items affected. If it's relating to the profit, you may have to adjust the retained profit, which is one example of equity. So you need to go and add or maybe reduce the retained profit due to the fact that you want to go and correct the error. And the third one is that under retrospective adjustment, you need to include any adjustment to the opening equity balance brought forward as a second line item. So you need to include extra line to the statement of changes in equity reflecting the prior period error, if that is about the error. And at the same time, after the discovery of the error, a disclosure notes must be provided to disclose the nature of the error and also what are the amount of the correction to the prior period error for each line item that are being affected in the statement of in the financial statement. However, there are exceptions to the application of retrospective restatement. So whenever it is impracticable to determine when is the period specific effect of the cumulative effects of the error, if you cannot detect specifically when is the period the error has started, is it at the beginning of the current period, that is fine. But if it's like, for example, last 5 or 6 years, you do not detect. So what you can do is you can, if there is impracticable to do so, the error shall be the entity is to restate the comparative information, and the error can be corrected prospectively from the earliest period or date that is practicable. To trace for the last 7 years might not be practicable. Let's say you can trace just for the last 3 years, so you will just go assume the earliest period is the last 3 years, so you will adjust them prospectively. So these are some disclosure on requirement for the error. So you have put this into prior period error disclosure requirement. And there are prior period errors here, is where financial statement of the subsequent period need not repeat this disclosure anymore. So look at what was in the disclosure, this, which is the nature, and also whether or not it is practicable, what are the line item affected, and the amount of correction at the beginning, and also what the earliest period presented. And if it is impracticable, what are the circumstances that led to that existence of the impracticable condition, and a description of how and from where the error has been corrected, starting from which period that you have done the correction. Right. Next, let's look at first example, where this example 7 is on receipt from trade receivable totaling 100,000 in 20x4. 20x4 was accounted as commission income received from trade receivable. So that is the situation that happened where the error is the commission income was wrongly credited. That is the error. And the retained profit brought forward as at 1st January 2000 x5 was 5.1 million, and you are also given the information on trade receivable balance in 20x4 was 500,000. Let's look at the explanation whether the transaction can be recognized as correction of errors. You are asked to determine the accounting treatment. Remember, it has to be adjusted retrospectively unless it is not practicable. So what was the error? The commission income was wrongly credited, and therefore the profit is being overstated. Profit is overstated. The income commission was wrongly credited. At the same time, trade receivable was also overstated. The reason is because the receipt from them was not accounted as a reduction to the trade receivable balance, but was accounted as an increase to the commission income. So according to Mfrs 108, if the transaction or the error is discovered in year 20x4, the current period error should be adjusted prospectively if the error is discovered in the year it occurred. So that should be adjusted prospectively, assuming 20x4 is the current period. However, if let's say if the error is discovered or detected in year 20x5, let's say here is 20x5, you detect the error here in 20x5, detection. But that detection of error relates to the prior period. So the error that you discovered here relates to the one that happens in the past. So that is the situation. So the what happened is that has to be adjusted retrospectively. So you need to not only adjust what happened at the beginning of the year, but you need to go and adjust retrospectively, which is adjusting back to the past. So in our case here, the error is that 100,000 was accounted as commission income. So we need to do the correction. where we need to go and reduce the commission income because it was wrongly created. We also need to go and reduce the profit for the year because it has been overstated, and we also need to go and restate and reduce the balance of accounts receivable. So the error must be adjusted to the opening balance of retained profit, and remember, retained profit brought forward was 5.1 million, and that would be reduced by 100,000, and that will give you a restated profit balance of 5 million. However, the trade receivable balance should also be decreased by 100,000. So that is going to be shown in the form of ledger here. So you have the assumption. Let's say the error was discovered in the current period, and let's say 2000x4 is the current period. Therefore, you are going to go and make correction by reducing the commission income that has been overstated. So we reduce, and crediting to the trade receivable, which is also to do the reduction of trade receivable, because before this, trade receivable was not credited as you credit to the commission income. So the income was overstated, profit for the year was also overstated, and at the same time, assets, the trade receivable, was also overstated since there are no reduction. If let's say the error was discovered in 20x5, so the error happened in 20x4, here, error, but you discovered here, you discovered error into 0x5. So that means that we have a prior period error. The prior period error will not be adjusted in the current year profit or loss because this relates to commission income. You will not go and debit to the commission income because commission income has been already closed off to the shopper. So what you will do is that will adjust the retained profit or retained earnings brought forward. So the profit must be reduced because the profit has been overstated. Same goes to the, in our case here, is the retained profit that is being overstated. Asset is also overstated. So both are being credited. Here is being credited to reduce the overstated. Here is being debited to also reduce the overstated retained profit with the same amount if that happened to be prior period error. This is the impact in the statement of changes in equity for the prior year adjustment, assuming it was discovered into 0x5 for the error that were committed in the 2000x4. So you have the balance as at 1st January, and this is the prior year adjustment, which is the error. And at the end, you need to go and restate the balance. The balance was reduced by 100,000 to become 5 million. The opening balance was being adjusted, the opening balance of the retained profit. Next, let us assume that the trade receivable balance as at 31st December 2000x5 was 500,000. So if that is the case, they will also give impact to the asset trade receivable that has been overstated, now needs to be restated or reduced with the error that caused the trade receivable not to be adjusted. So minus 100,000, which is the prior year error. So the trade receivable now will be at 400,000.